I know everybody's finding their schedules a little bit more hectic these days, so I appreciate making some time for me. Um, I want to start off by saying, first and foremost, I hope that all your families and loved ones are safe and taken care of in this time. That's certainly what's most important. But outside of that, I know there's a lot of concerns floating around, and I want to take a little bit of time to help in whatever way I can to provide a little bit of calm in this sea of uncertainty. I know that, first and foremost, there's a lot of health concerns. Beyond that, investing is frankly not everyone's even biggest financial concern with people being laid off. And I just think in a time like this, of all the things you can and can't control, your investing should, not be high on your priority list. And so I just want to take a little bit of time to share some insights and hopefully, give you a little bit more basis for what you're thinking and most importantly, what you're feeling right now. Um, I'll do my best. Obviously, this is my first webinar. I think we've all learned recently just how frequently we touch our faces, and I'll do my best to avoid that and to communicate clearly. But please feel free to drop any comments into the chat, and there's also a Q&A. Hopefully, I'll have a little bit extra time to answer what questions I can, and if I can't, I will follow up with you directly via email. So thank you, and let's get started. So there's a few things I wanted to address today. First and foremost, investors are nervous, and that's understandable. I'm nervous too. I'm not nervous about financial markets, but I'm nervous about the world largely that we live in. There's a tremendous amount of uncertainty, and anybody who's been a client of mine for any amount of time has heard me say repeatedly, investors hate uncertainty, and they react to that uncertainty very negatively. And I think we've all witnessed that in the markets recently, or at least seen some headline about the markets. And, there's a tendency as investors to try and draw back to common time periods and, try to rationalize this by historical examples. And I think we're finding that there isn't a good historical basis for this. Everybody probably most recently remembers 2008. And, we're quickly finding that that was a very different time period than what we're experiencing now. 2008 was a financial event caused by a financial issue. And today we're experiencing a financial event caused by a biological issue, which has an entirely different set of resolutions and an entirely different set of uncertainties. And, for that reason, I think markets are reacting as we're prone to do as humans, and maybe irrationally in the time period, but it's the only way we know how to react. The second thing I want to cover is a lot of financial news you're receiving and a lot of what financial professionals are trying to probably telling you is to do nothing. And I know as investors, doing nothing feels like you're being passive. It feels like staying the course is not doing what you could be. With all the biological issues, you can wash your hands, you can cover your sneezes, you can isolate, and there are things you can do. But doing nothing with your investment portfolio feels like you're being passive. And I want to stress that that's not the case. Doing nothing, making no changes in your investment portfolio is actually a very active decision. It's especially active emotionally because you feel it and you're tested every day when you get the news. And it's active in that it's based on a lot of experience and research, and frequently is what smart money tends to do over time. So not making changes abruptly is actually a very conscious and smart decision. And lastly, I will look at some data about kind of where we are in the markets now and where we are in the economic cycle. And I think this has been really telling because similarly to you getting a lot of data about the spread of the coronavirus and COVID-19, a lot of it doesn't do much to make you feel better. And that's very typical of financial markets. You frequently get a lot of data and you say, yeah, but that doesn't make me feel any better. So we'll go through that as we always do in these times. And, maybe you'll take something away from that. So we'll start with a comment I've maybe heard recently from some clients, or at least I know some advisors are hearing from clients, and that is, why didn't we get out? I knew this crash was coming. Why didn't we go to cash and avoid all this? And, my typical pushback on that is, did you really know? Did you know, or did you feel that this was coming? Because in prosperous times, it's very common to feel that a downside's coming. These are common human emotions. We have a tendency to have a hindsight bias and say, this was obvious to me. I knew this was coming. And I would challenge that and say, based on what? Did you know it was coming? Did you know when it was coming? What data were you looking at? And even if you did, and you were certain that you could get out at the right time and time a market pullback, is that data sufficient to let you know when to get back into the market? Because every decision to get out of the market has to carry a second decision of when to get back in. It's two decisions always. And frankly, we have a cognitive limitation as humans that says what's now will always be. And, I just need to be in cash right now, and not to look forward and say, oh yeah, the market premium that I received by being an investor, which is one of the most surefire premiums we all can know and identify, I have to participate in it at some point in the future to achieve my goals, to get the returns I need. And will I be able to do that if I were to have even timed this decision perfectly? So that's a little bit of the conversations that are going on. I'm sure some of you are having either with me or with your advisor. And that's okay. I want to stress that it's common to feel emotional right now. If we're just looking at the past week and a half of the S&P 500 returns, you've been through a lot as investors. That is clearly the definition of a roller coaster. There's been some incredibly bad days, and there's been some what are traditionally incredibly strong days. But you've survived them all. You've experienced them all. It's taken a toll on you. And it's common as humans to have a desire to be reactive to that. And going on to that, maybe you've gone out and talked to your advisor or talked to a financial professional, or consulted new news sources, and you've started to see this reoccurring of common advice, to say, what should I do? And maybe you've seen a range of advice. On the low end, maybe you're seeing people out there tell you to go and buy the VIX and trade the volatility or short the market. And on what I would consider the high end, you're maybe getting the advice to stay the course. And I think a lot of this goes as investors to what some of you may be familiar with is the Dunning-Kruger effect. And I think that is, commonly when you have experience investing, experience in markets, you are familiar with this transition along the range of this effect. At the low end, you may be up here with what's so kindly labeled the peak of Mount Stupid. And that is, you've got a small amount of experience. And from that small amount of experience, you think, I know everything. I know everything there is. And you're incredibly confident. And, this might be the Wall Street bets out there, the let's sell some puts, or let's, short this or trade volatility. And on that limited experience, you think you can make a profit. But moving along this experience, as you've been an investor for an average amount of time, it's unfortunately common to end up in this valley of despair. And this is where I find a lot of clients and a lot of people I'm communicating with. And that is actually predicated on the fact that you do have some experience. And so based on that experience, you're out there saying, oh God, I actually know nothing. Everything I thought to be true has come untrue. And with my experience, I'm hopeless. I thought I had experience, and now I don't know what to expect going forward. And that's a very lonely place to be. And it's a place where, you can feel depression in this, depression being the clinical definition of an inability to construct a future, right? So you're down there saying, I don't know what to expect going forward. And, all is lost. But when you deal with professionals and when you expand your investing experience, you tend to move out this, what's so kindly labeled slope of enlightenment. And enlightenment, in this definition, is not so much I know exactly what's going to happen, but more so, I know how much I don't know, and I know how complicated it is. But based on that, I can draw some conclusions, and I can make educated actions based on that. And hopefully, the experts that you're out there talking to are out in this range and, giving you sound advice based on their years of experience. Compounding that, and the lack of experience, is this natural human effect. It's a cognitive distortion, and that is humans have a tendency to catastrophize. And that is because as humans, it's a well-documented attribute that we experience gains much less favorably than we experience the negativity of losses. Obviously this is a famous Daniel Kahneman and Amos Tversky paper that found, we experience gains 1 times as good as comparatively to a similar loss that would feel 2.5 times as bad. And this is why at times like this, we're prone to be reactionary. And it's the reason why when times are good, we construct well-designed portfolios that have a well-adjusted risk return so that when the market does inevitably pull back, and they do, we can participate less on the downside. And frankly, it's the reason why you can call your advisor in up markets, straight up markets, and say, hey, why are we up only 10% when the market's up 12? Because you have a well-diversified portfolio and you have, downside protections. And so, that being up even 10% or a large percentage doesn't feel as good when you could potentially know that others are getting better returns out there. But on the downside, you still feel just as bad. And so from that, it leads you to want to take action and be emotional, especially when the market's down. And this is another chart that I commonly point to, and I'm sure some of my clients are familiar with. And this goes to, the effect of timing the market. And I'm sure you've probably all heard from a financial professional these days, the old adage of it's time in the market, not timing the market. It's a pretty corny one, but we're all apt to use it from time to time. But this just points to the fact that, even if you can time the market in some effect, just missing one good day, lops off a good amount of return. This takes you from a 9.96 annualized to a 9.56. So 40 basis of return annualized over a 30-year time period for missing 1 day in the market. And beyond that, if you just miss the 5 best days, you're lopping off nearly 1.5% annualized of return. And once you get out to missing 15 and 25 days, you've drastically cut your return. And the reason why I like this chart is not because of the significance of the numbers, but the fact that actually we're not cherry picking the bad days here. I'm not saying, hey, if you could just avoid the bad days, you could improve your return. I'm saying you just coincidentally miss the good days. Obviously, it's your goal to be in the good days, but because of timing, because of your decision, just missing these days can have a meaningful effect on your portfolio. And in that regard, it's not shocking that a lot of these really good days came very close in proximity to the down periods. If you remember back to the chart from a couple days ago, we had one of those really good days in the midst of last week on Friday. So, in that regard, you can't time those. Obviously, nobody wanted to miss that day. And just, compounding on that advice, looking at the markets that we've experienced in proximity to more than 10% down markets. So when the markets pulled back 10%, the average following market, in the 1 year next period has been up 11.3%. And over the following 3 years has on average been up 10.2% annualized again. And over 5 years has been up 9.6%. So these are very strong positive markets in which you want to be participating. But again, by getting out in a down market, you potentially don't get back in to participate in these good markets. Even just sitting out, saying the market's down, I just want to sit out 1 year, and putting a time period on that, you're giving up a potentially very strong market. Beyond that, this is, I've shown you some charts and I've talked about this, but I think it's important to, however cheeky, compare this to an actual situation. And, it's called a bear market for a reason. For many years of my career, I didn't draw the conclusion between a bear market and an actual bear. And in this regard, there are striking similarities. Both are terrifying emotionally. It feels like everything's at stake. And your instinct as a human is to run. As an investor, you want to go to cash. You don't want to be here as much as you don't want to be face to face with a grizzly bear. But unfortunately, we all know the best thing to do is to play dead. And that's tough advice. It's tough advice to give. And I would argue that it's especially tough advice to read, to get from a robot or a robo-advisor or a computer. If a computer is telling me to play dead, my response to the computer would be, well, your life's not at risk. But when this advice is coming from humans and you actually consider the source, and a human can tell you, I'm taking the same action with my financial future, I think you can put some solace in that. And I hope you are having these conversations with an actual human. Beyond that, I'll draw an anecdote that's, come to mind. There is an old story, and I will say it's probably a myth in investing circles at this point, and I'm sure it predates internet fact checking, but it probably has been disproven at this point. But it is said that some time ago, Fidelity Investments did a study in which they looked at the data of all their client accounts, and they tried to parse out what the best 1% returning accounts were. And in doing so, they found an overwhelming similarity between the best returning accounts over a long time period, 20 years. And that similarity was that all those account owners were dead. So by definition, they couldn't take action. And of course, I'm sure it created an administrative nightmare for them having to clean up lost accounts. But the overwhelming similarity was that they were dead, they couldn't do anything, And so their portfolios remain unchanged, and they beat the portfolios of active investors. So that being said, you can say that's great, but as a human, are you really just saying, let's do nothing, let's sit here, or are you being active, and are you looking at the world as we know it? And we are. Unfortunately, in this uncertain time period, our economy is going through a crazy transition. Obviously, people's livelihoods are affected. That leads to kind of what's frictional unemployment as we've known it. Hopefully, something that will be resolved. Hopefully, consumer demand will bounce back at the resolution. And I don't think that's an unfair baseline assumption. A new consumer confidence number came out last week. It was down 5% from what were historical highs. And that is not unexpected. It's probably something that will continue. And I don't want to create an air of false precision that looking at these numbers, we can anticipate anything. At the time of putting this together, the action that we had over the weekend was the Federal Reserve had taken action to cut rates and to increase lending. That is an action that we're very familiar with from 2008. And, I would argue is a less effective action in this time period. And frankly, if we're looking back at 2008, and this is why I draw such a distinction, in 2008, at the onset of the financial collapse, U.S. banks had less than $2 billion in excess reserves. Today, those banks have over $1.5 trillion in excess reserves. So by nearly a factor of 1,000, banks are significantly more healthy. And so we're not feeling the strain on the financial system, obviously, but we are feeling economic strains. Compounding this uncertainty, the goods that we demand every day have changed drastically. And, we've all heard the price gouging stories, but we don't know where that's going to feed through into our inflation numbers. Obviously, our Federal Reserve has a dual mandate: one, to stem unemployment, and two, to control inflation. And there's not clarity yet on what this is going to mean for inflation. Interest rates being at zero certainly means that our real interest rates are negative for the foreseeable future. And I know that leads to people questioning, does that put us kind of in the Japan trap where interest rates are non-existent for a long period? And these are all uncertains. If the biological event that we're experiencing resolves itself in 2-3 months, then the base case certainly becomes that there will be a rebound. Companies came into this event with tremendously strong earnings and a lot of cash on their balance sheets, very healthy. And so there is still a very big upside case. And Rob Arnott said this week, the strongest bull markets are not built on good news, but they're rather built on diminishing bad news. And I think there will be an inflection point where we start to get some clarity and bad news starts to diminish. And I think stock markets will reflect that. Finally, the dirty word that gets thrown out frequently is recession. And this is shocking to me as an economics student, because in my world, recessions are an inevitability and they're part of economic cycles. And the visceral reaction to the thought of a recession in much of the media or financial writing is shocking to me. Since 1929, there have been 47 recessions in the US. That's a lot. The average amount of time was 6 months for a recession. And again, and let me take a step back. What is a recession? A recession is 2 quarters of negative GDP, 2 consecutive quarters of negative GDP growth. Sorry. And I think we can say with certainty that this quarter is going to show negative GDP growth, and most likely so will next quarter. So when you hear inevitabilities about a recession, I don't say they're overblown, but then they are a cycle which works itself out. And to that point, you know, on the left here, you can see a cycle of expansions and recessions in our economy. Going back to 1900, the average expansion was 48 months and the average recession was 15 months. And they are in a fluctuating cycle. And you can see over time, you know, obviously 1929 was the outlier on recession length. And since then, they've been trending downward in length. Obviously, 2008 was a long one. And we've bounced back from that with a tremendously long expansion. And a lot of the hype has been, well, at 128 months, we are in the longest expansion. And this goes back to humans' tendency to catastrophize and say, this is an inevitability. But the reality is, and on the right, you can see the most recent recovery has been relatively shallow. And that's for a host of factors, largely, you know, the low interest rate environment that we've been in. But this expansion has not been nearly as robust. And so the pullback is likely equally shallow. You know, the average recession since 1945 has been 10 months. So we're talking about 3 quarters, you know, which seems very likely, but probably puts us back to a not deeper place of growth with less pullback. And some good news. So what am I looking at when I look at the stock market? My clients know that I can be very fundamental, that I can, you know, I love to look at fundamentals of companies and look at valuations. Obviously, you know, looking at the forward-looking price to earnings ratio of the S&P 500, which is a common variable for how expensive the stock market is, we can see the tremendous drop as of late. You know, at the end of last year, we were at a PE of a little over 18, and now we're at about 13.7, sorry. That is a tremendous drop. That goes from almost 1 standard deviation overvalued from the 25-year average to almost 1 standard deviation undervalued. So now would be a time for my favorite Warren Buffett quote. It's not a financial presentation without a Warren Buffett quote, right? So my favorite is, I like my stocks like my socks, on sale. And stocks are certainly on sale right now. And why is that? Stocks are the one market where when the price goes down, humans tend to demand them less. And when the price goes up, investors demand them more. It's the exact opposite of every other market you'll ever participate in. And that, you know, that goes to the emotional behavior that comes with having your savings, your retirement involved, and frankly, rather large numbers. Investors that were just participants in 2008, and remember that time period, are dealing with much larger financial balances right now. And with a larger balance comes a larger emotional response. So as much as I can tell you, you know, it's cheap and stocks are on sale, that is very frequently not going to drive somebody out there to go and buy at a fire price. But stocks are cheap. And those of you that are contributing to your portfolios or are rebalancing your portfolios, you are getting a bonus right now. And obviously this is subject to earnings in the future that we come to realize, but it's a much better entry point for your stock purchases than it was even a few months ago. So I said all that, and you're still not convinced, and you don't want to think about investing right now. And you're saying, but I do want to take action. You've got more time on your hands. You're working from home. You're self-isolating. And so you say, what can I do? Well, there is a whole other side of your financial health that we as advisors work on, and this is why you hire us. There's plenty you can be doing. You can be doing a lot of financial planning. My clients know I'm often on them about getting their healthcare proxy and their durable power of attorney done. These are simple documents that can give you a tremendous amount of peace at night, knowing that your wishes will be carried out should you have a medical event, and knowing that your affairs will remain in order in that time. Most states have a template document for these, or it's something you can accomplish very cost effectively with an estate planning attorney. And so doing something that can make you feel accomplished and frankly put you a lot better off is low-hanging fruit in these times. Secondarily, finish your estate plan. I know countless estate plans that are out there in draft form and not signed and executed, or are people that are saying, I really need to get around to that. This is something that you can accomplish entirely virtually now in these times with the extra time you have on your hands. So reach out, get your estate planning done, especially, knowing that you have guardians in place for your children, or, the proper planning, or that your assets will avoid probate, and your wishes will be carried out. These are things that you can concrete take with you at the end of the day. Thirdly, I know we got an extension recently, but get your taxes done. You've got an additional 90 days, but a reoccurring theme I hear from clients is, I feel like I could be doing more on my taxes. I've never given them that hard look to say, are there opportunities I could be taking advantage of? Am I doing everything the best I can? Or am I just plugging it into TurboTax and letting it go? So sit down with your accountant, sit down with your advisor, look for opportunities that you may be missing out on. And finally, and I think this is a big one, revisit the whys of your financial plan. Why are you doing it? What are you saving for? What are you putting these things in place for? Why do you feel emotionally negative over the movement of the stock markets? Is that because you worry that you could be stuck at a job you hate for another year? Or you worry that you might not have the funds for your children's education? And sit down and revisit how recent events have affected this, and what does it really mean? It might not be all great news, but at least you can put a concrete framework around how this has actually affected you and why you are so concerned. And so that's a great time, if you're meeting virtually, to take advantage of it, talk to your advisor. That's what we're here for. And to that point, I think a recurring theme is that everybody has an overabundance of time right now. They're not going out to social affairs on the weekends. So reach out. Let's be in touch. If you, client or not, if you just want to schedule a time to chat, you can go on my website and grab a time, or you can just give me a phone call. I am here and available. And I thank you again very much for your time. I see a couple questions, and I think I will answer those individually, but thank you, and take care and be safe, and enjoy additional time with your loved ones if you can find it. Thank you.